I don't think I need to do the net asset calculation as such, because I'm simply told at the date of acquisition included in the 500 was a fair value adjustment of 20 which related to plant. So I know my fair value adjustment is 20 and the plant has a life of 10 years. What is my answer? 6 or 2? 2, yes. I want the depreciation expense for the year. Now that is going to go, that is my takeaway. That is my figure that is going to go in cost of sales. Yeah? That is why I have done the working. I have labelled it, it is called working 2, so when I put it in my answer, I can show it's working 2, and I know the number there is 2,000. I'm very happy with that. That's okay. Number 3, calculating the impairment loss. So there's a sub-paragraph, goodwill is to be impairment tested. Bit of an anticlimax because it says it's impaired by 30%. So I'm robbed of the opportunity of doing a proper impairment review. I'm having to calculate the goodwill, then whatever the goodwill is, 30% of it is taken. I want the fair value of the parent's investment. Now that is given to me at 450. If it's a step acquisition, there's 2 investments. If it's a step acquisition, the old investment is revalued to fair value and the gain goes to profit. If it's a step acquisition. If it's a indirect sub, then there will be an indirect holding adjustment. These things are not present here. 2 ways of measuring NCI, fair value. We have here a fair value and the NCI at fair value is 110 based on the share price. This then gives me the fair value of the net assets at the date of acquisition, and the fair value of the net assets at the date of acquisition is said to be 500. Perhaps you would have to work out that figure. You know, it could be a trick, but the information is given, there's no changes or revisions, so the 450 plus the 110 minus the 500, this gives me a goodwill of 60. This is of course giving me full goodwill, the full goodwill. Now, I would ideally like to do an impairment review properly with a cash generating unit, with the net assets at the year end, but that's not the case. So I have an impairment loss, which is simply mathematically given to me at 30% of 60. 30% of 60 is 18. And this figure here becomes a key takeaway. This figure here becomes, where does it go? I'm specifically told that it goes to cost of sales. This would, of course, have an impact ultimately on my NCI. So there will be an impact on my NCI because it is full goodwill. But the figure I charge in cost of sales is 18. Yeah, the figure I charge in cost of sales is 18.
Why you give you like the net asset?
The reason I've done this working is to get 18.
No, because we didn't add the year in net asset and the goodwill and everything.
No, we just, I had to deal with the information given to me, and the information given to me tells me that the goodwill is impaired to the extent of 30%. I mean, what would be far better would be in another question, as we have done. If you're doing the impairment review of goodwill, you're doing an impairment review of a CGU. So you would have your year-end net assets, whatever that is. You would then have your goodwill, and then your goodwill is 60,000, and there's no need to gross it up. And then you would have your recoverable amount, and then you would have your impairment loss. So I mean, you could work it back if you want to, because if your impairment loss is, anyway, whatever, yeah? So, you know, I don't know the recoverable amount, I don't know the year-end net assets, so I can't physically do the impairment review in the traditional way. I guess we're just trying to take a shortcut and remember how to do impairment reviews, yeah? Remember how to do impairment reviews. But I've got my figure for cost of sale. So what else have I got to do in respect of the first sub? I've got to calculate the gain to the group on the disposal. Because on the last day of the year, we sell and this is after the impairment review. We sell it for 500. When we sell it for 500, we're left with 10%, so we go from a controlling interest of 80%, so we own 80%, we sell 70%, and therefore we're left with 10%. No way is that control to control, that is a disposal. We've lost control, and therefore there will be a profit or loss. The sale of the shares has not been accounted for, so we've got a blank sheet of paper. Tax can be ignored. We've got figures here. Now, before revision, part of what you've got to do is effectively look again at each of the accounting standards that we've done and be able to write out a definition to remember the key issue around deferred tax. The key issue, the definition of a finance lease. Yeah? How we account for share-based payments. Each accounting standard deserves to have a couple of sentences that you can write out in very general theory. You also need to be familiar with your pro formas. So you can calculate goodwill, you can do the impairment loss, you can do the profit to the group on disposal, you can do the control to control. And this is a classic example. If you know the format, this takes you about 2 minutes. Yeah? So in the gain to the group, it's all about de-recognising the net assets, de-recognising the goodwill, de-recognising the NCI, but the NCI is a credit, so it comes in as a plus, and then bringing in the residual, and you bring in the residual at fair value. If it was an overseas sub, then you would recycle, the group exchange difference. If it was an overseas sub, then you would recycle the foreign currency exchange difference. But that is not the case, so I shouldn't perhaps bang on about it too much. This will then give you, if it's a positive number, this will then give you a gain to the group, and that gain goes in P&L. So let's see what information we've been given, because you're not always given all the information, you sometimes have to work it out. On the last day of the accounting period, after the impairment review, we sell shares for 500,000. There's the proceeds. This leaves us owning 10% of the shares, which are valued at 50. We no longer have control, it's not been accounted for, tax can be ignored. At the year end, the date of disposal, the net assets of YAT are 600. And the NCI is 120. How much is the goodwill?
22,000.
There's the goodwill. The original goodwill was 60, of which we've written off 18, so we're left with a goodwill of 42. Goodwill is 60 minus 18 at the date of the disposal. After the impairment review, the goodwill is 42. So our gain to the group, should be, let's have a look, 500 minus 600 minus 42 plus 120 plus 50. We get a gain to the group of 28,000. Now that's my takeaway. That's my takeaway. That's the figure that will go into my final answer. I am pausing for a moment. I think it's wrong to think of a group accounts question as a big 35-mark number crunching question. I see it more as 10 or 12 small problems. Can you calculate goodwill? A couple of marks. Can you sort out the post-act? A couple of marks. Can you deal with the exchange difference? A couple of marks. Can you deal with the associate? A couple of marks. Can you deal with the fair value adjustment? A couple of marks. Can you deal with the control? So it's not about an enormous question. If you think about it as an enormous question, you get lost, you get drowned. Oh, it's too much. But if it's a series of small routines, a series of small steps, a series of little things that you do, then when you're in that little zone, that's what you concentrate on. I do the next one, I do the next one. So I have finished the first subsidiary. I have processed everything to do with YAT, unless somebody is going to talk to me. Second paragraph, Sun acquired 75% of SEN. Sun acquired 75% of SEN. And this was acquired on the first day of the accounting period. On the first day of the accounting period, so we have owned the subsidiary for 1 year, so there is no time apportionment happening on that basis either. We bought it for dinars. The book value is in dinars. The net assets have a fair value adjustment. There's a 5-year story. We account for NCI on a net asset basis. So goodwill is attributable to the parent only. There is no impairment loss. What workings do I need? What do I need to work out? I've got a foreign sub, paragraph number 2. We've just read the information. What jumps out at you that you would need to do? Yes, depreciation. You would need to work out the depreciation expense because there was a clear reference to a fair value adjustment. Not only was there a clear reference to a fair value adjustment, but there was a reference to 5 years. 2 minutes, please. 2 minutes, please. Can you work out this depreciation adjustment?